Last Tuesday, oil had massive profit potential, but many traders failed a few crucial details in their analysis that led to unnecessary losses. Let's break it down. The aftermarket session, which starts the DR-IDR intraday cycle, has ended and gave one trade opportunity after a retracement back to its lows and closing price, which unfortunately would have resulted in a loss or break-even trade depending on your risk management. The aftermarket DR session is the foundation for the day. And inside my academy, I mainly recommend trading the overnight or regular session and use the aftermarket as a guidance. Each breakdown will more and more emphasize on why the aftermarket DR session is the building block for the rest of the day. So at 3 a.m., the overnight DR session opens and forms until 4 a.m. In this case, it closed as a green DR box, with the closing price being slightly higher than the opening price. Without any confirmation, what would you as a trader do next? Analyze what has happened so far and add what's given is the answer. Based on DR models, an upside and downside model is already broken. This should be clear to everyone. With the overnight DR session increasing in its size compared to the aftermarket session, a DR range expansion model is intact, which gives strong signals for a potential trumpet-like price action already. To the left, there is the previous day's regular DR session high and also the aftermarket session highs and lows lining up with the current range. Volume imbalances are pretty clustered and you can reduce them to ones that are magnetic for price inside the range that haven't been rebalanced yet. Adding intraday gap imbalances is what gives you a crucial information. Again, it's the one from the aftermarket DR session that holds the most valuable lesson. See how the overnight session opened and pushed higher to take out the aftermarket DR session high and literally stopped with the body right at the intraday gap imbalance that has been created just before the ADR started and then rapidly priced down? Must be completely random, I guess. A few minutes later then, the short confirmation followed and price took out the aftermarket lows as well. Looks like both sides of the market are already being played, huh? Moments later, price offers you this, a rejection from the aftermarket lows combined with intraday gap imbalances. Would you feel comfortable taking a short trade here? Technically, it's reasonable, but the cons overweight here. Data-wise, Tuesday overnight sessions on crude oil with a short confirmation have a relatively low rate to hold true. It sits at 68% in total, while short confirmations in the first half an hour from 4 to 4:30 a.m. drop to even a 64% true rate. That is significantly lower compared to other sessions, where it's at 80% or even more. Another con is the already shown path in which price has moved so far. The overnight session took out both the ADR highs and lows. There's also an open magnetic volume imbalance at the top of the range, which should definitely be kept in mind. Knowing that, you can give it a try here, but definitely don't want to place a second bullet during the session, given the lower probabilities. Price drops lower but fails to make a new low before confirming a false session. Not really surprising when knowing that there was a 36% probability for that to happen and the model constellation already gave indications to that, right? That's definitely a session that could have been avoided. Let's continue. The regular DR session opens at 9:30 a.m. and forms until 10:30 a.m. With the 10:40 a.m. candle, it confirms into the long direction. Into which direction would you prioritize trading? Would you trade into the short direction here, hoping that price continues playing both sides of the market? Sure, it can happen, but if you really think that way, you should rethink trading. Besides the fact that Tuesday regular DR session held true 84% after a long confirmation in the past 18 years, this price action has way more to offer. When comparing all three DR sessions in its sizes, it is evident that each one of them expands in its size to the previous one. A classic DR range expansion model is forming, which also gives a high probability target of one standard deviation. This target has been reached around 70% historically in a true session. Amazing. At the middle of the range, there are three intraday gap imbalances stacked up relatively close. They can act as a no trespassing area for price. On top of that, the aftermarket and overnight session highs line up as well, which makes this area a key level. With the other strong barrier deeper in the range, you'd ideally not want to see a DR false session, given the 84% probability for a true session. The next 6 candles all reject the IDR high level, not able to close below it. That's your shot. 30 minutes of pure rejections. Do not get too focused on the predefined areas like the mid of the range. In such cases, you have to be a professional decision maker and have your mind sharpened, fully focused on the present situation as it forms. There's no reason to ignore these rejections from the IDR high here, as the implied defining range plays a crucial role in the DR trading strategy. And if this trade gets stopped out, no problem. Another great opportunity will most likely unfold in this clustered area, which gives a potential 5R. For this trade, your stops could easily be placed below the closing price and still it would offer more than 3R. Price does what it has to do and expands way beyond the 70% probability target in a DR range expansion model. Another beautiful trading day that with just a few DR basic teachings and statistics on top of that could have resulted in a profitable trading session. I hope you learned something new today and gained some insights to the DR trading strategy. If you want to improve your trading and dive deeper into my concepts, then feel free to visit M7DR.com. Have a good trading week and I hope to see you in the next video. We're gonna take on the world.